Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex.
Chicago soybeans. Prices have, overall, for the most part, continued to move up and away from the previously highlighted congestion zone, made up of the lesser Fibonacci lines at 1400, 1389 and 1378. I saw the area of these lesser Fibonacci lines as an ammunition gathering exercise for the move higher. Plus, we have the results of the larger process in operation, and that is the July to late October descending triangle, which I've highlighted in dark blue on my daily chart. The upward trend line used was the now defunct mid-August to date downtrend and backed up a little higher, up for most of the time, by what was at that time a paralleling and declining medium moving average, currently at 1449. Meanwhile, below those same levels of 1400, 1389 and 1378, they acted as the base of the triangle. And yet, at the end of November and going into December, prices punched up and over the 50% Fibonacci line of the December 20 to February 22 move at 1451, whilst utilizing the base of the medium moving average to do it. The potentials on the upside from the descending triangle pattern, as I said 11 weeks ago, were, and I quote, "So, taking all of that into account, a primary target X will be in the 1545 area, and a secondary and much harder to reach target X1 will be in the 1605 area." End of quote. I also added something at the time which has turned out to be very prescient, and I quote, "So what have we topside that might get in the way?" Well, to be honest, not much. Which is why I'm a little surprised and concerned that prices have not moved higher than they have. You see, we have highs in September at 1493 and 1508, but the next clear resistance topside is in the band between 1521 to 1534, containing a flatlining long moving average. Well, the long moving average is now dipping lower and is currently at 1496. And I continue, and the 50% Fibonacci line for 2022 at 1532, and that's the end of quote. Well, prices eased higher, breaking over a number of capping factors, including the long moving average, initially breaking up over that in late December, and then again more forcefully 2 weeks ago. The market started utilizing a new pattern, a bull channel from mid-November, currently 1506 to 1548, which I've highlighted in purple on my daily chart. In the process, prices last weekend breached but did not break the next resistance, and that's the 50% Fibonacci line of the February to July last year, February to July 2022 move at 1532. And at the same time, prices also tested the upper bull channel line, as well as reaching a high on Tuesday last week of 1544 3/4, or only a quarter under the optimal target X of 1545. Now, I could say it reached that area, which would be fair, but I'm interested in the action as well, as the day ended up as a daily key reversal down. Last week I commented on this, and I quote, "Now normally after grazing a target that way, I'd pay special attention to the pattern and knocked it lower. But this time I am cautious about yesterday's action being a turn lower. You see, the action still looks somewhat lacking in strength, though would still give the action over the next few days some close attention. I'm just mindful that the bull channel just looks a lot stronger than this one-day pattern, at least for now. And that being said, target X1, the secondary target topside, is still a long way away." And that's the end of the quote. Well, since then, prices have headed lower and punched down through the lower bull channel line. And I thought, I better start sharpening my crayon to give potential targets below. But then it created 2 3-day bullish patterns. First, a bullish morning star pattern over the first 3 days of this week. Secondly, a possible horn bottom with those same 3 days. Thus, this has resulted in prices now up and testing the lower bull channel line, but from below. If this is a recovery and possible repair of the bullish incentive, then there are 2 possible options I can see here. Firstly, we go back to where we were, within the purple bull channel line again. This is possible, though the false breaks either side leave a lot of questions. Secondly, perhaps, just perhaps, the market is now moving over to a shallower bull channel type action, originating from late December last year, and the ones I've highlighted in bright red. That's currently 1476 to 1548. I suppose the third option would be a straight move lower, but I have a suspicion that may not be the way, at least not right now. Chicago soybean meal. We've had here, and have here still for months now, different patterns, not so much melding in with each other, but rather crashing in and out of each other. The main pattern continues to be the May to date seemingly broken, then repaired, ascending and expanding wedge pattern, something I pointed out many months ago. This had developed, but is looking pretty ill now. It was never a perfect pattern by any means, but it seemed to work until the end of last year. To assist in seeing this pattern, I highlighted it in dark blue. It's worth noting that the lower trend line is also the neckline of the huge December 2021 to June 2022 head and shoulders continuation pattern. Now, upon reflection, I think I will downgrade it for next time, as there is enough going on nearby that deserves closer attention. The next patterns to look at are the ones that caused the peak of the market in early December last year. It was the combination of the 2021 high at 471.40 and the neckline, which I'd highlighted in bright red, of the February to April 2022 head and shoulders top, currently at 474.5. I should perhaps clarify these as having caused that earlier peak and then helping erode the subsequent early January rally with the June 2014 high at 479.30, eventually capping the rise. Now, since that peak, the market has staggered lower, which includes a changeover gap action 2 weeks ago, and that's between 475.20 to 466.80. That's only been partially filled. Since then, the market has dropped down to just short of the April 2021 high at 479.30, where it has seemingly found some ammunition to hold up, but no more than hold within the congestion made during December last year between about 445 even to about 460 even. This has left us, as I said last week and the time before, with the question of what may be the likely patterns in the coming weeks ahead. Initially, I indicated there was a definite tendency to look at the late November 2022 to January this year action as a possible bullish halfway hesitation. The changeover gap has dented that idea, though it is, for the moment, still out there. What this gap has done is add the concept for the same action, instead of being a bullish halfway hesitation, instead that it may be becoming a possible lopsided double top. I'm the first to say neither idea is ideal. Indeed, they are both far from ideal, but that is all that is showing right now. Needless to say, it is too early to even contemplate targets for either of these potential ideas. Chicago soybean oil. The key recent features here have been feature 1, the lower time, currently at 60.99 of the December 21 to June 22 bullish shift pitchfork, which I've highlighted in dark blue on my daily chart. This lower time, along with feature 2, the April 20 to date uptrend, currently at 61.37, which I've highlighted in bright red, both halted a decline in mid-December last year and started a subsequent move higher. This move higher was not accomplished just with these two. No. They had help, as just below both of them is a whole series of other supportive features, including the 2011 high at 61 even and supports at 59.44, 58.82 to 58.16. Inside of that support, inside of which there is also the August 2011 high at 58.59 plus the September 2012 high at 57.64. This all caused the market to revert back up. In the process, prices formed an interesting small ascending wedge pattern over December last year. I've highlighted this pattern in bright green. In late December, the market broke down through the base of the pattern, thus initiating a primary target in the 64.08 zone and a secondary much harder to reach target X1 in the 58.82 zone. Now, the primary target was easily achieved, but the harder to reach secondary target is still out there. Since the break lower, we have seen the market clinging for the most part, like just so much washing to a washing line, onto the lesser Fibonacci line at 63.73 that is just under the 50% Fibonacci line of the January 21 to April 22 move at 64.09. The question I asked last time was, and I quote, why the market has not taken the opportunity to drop lower, end of quote. Well, that had been easily answered. The lower time and the uptrend have both advanced higher since early December, and they are now mingling with the 2011 high at 61 even. I said last week, and again I quote, in mid-February these three will start separating out and thus reducing their combined efficacy. And if we are still around here at that time, then perhaps it may be time to see prices test lower. End of quote. Well, it seems we didn't have to wait until then, as late last week prices started to head lower, and this week they have smacked bang into both the uptrend and the lower time, as well as the 2011 high, and closing yesterday below both for the first time. Today there has been a small recovery, but my thinking on this is that all the market needs to do is to hang around these levels. Doesn't need to go down, just hang around these levels, as each day the concentration of support from these three patterns and actions is slowly being diluted by time. Hence I suspect we would need to see prices back up over the 50% Fibonacci line at 64.09 to offset the possibility, or a possibility, of the market moving down towards the ascending wedge target X1, and that currently seems unlikely. In the meantime, we have three declining bearish moving averages capping the market. The medium moving average currently 66.37, short medium moving average currently 65.94, and the long moving average currently 68.88. Two of these three, the medium and the short medium moving average, made a dead cross early this week. This is a lagging indicator, but it is still an indicator of the market.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.